A very good afternoon to everyone who's on this call today with us. I am Chirag Joshi, the Chief Growth Officer at Samco Mutual Fund, and I welcome you all to this annual unit holders meeting for Samco Flexi Cap and Samco ELSS tax-saver funds. On this call today, I have with me our CIO, Mr. Umeshkumar Mehta. I have Nirali Bhansali, who's the fund manager, and Dhanani, who's the foreign fund manager. So without further ado, I would request Mr. Mehta to take forward the call.
Thank you. Thank you, Chirag, and a very warm welcome to each and every one of you. Markets are at all-time highs. Shall we wait? Shall we invest? So there are so many questions, a lot of commentaries, a lot of opinions. Let's see one by one. So what I'm going to do in next 5-7 minutes is I will broadly cover the macros and how markets look. And then for next 20-25 minutes, Ms.Nirali Bhansali and Dhanani will give the portfolio and scheme update. So India, you all will agree, is the fastest growing democracy in the world. India, you all will agree, has the youngest population. And today, India is the most populated country on this earth. India as a script is bound to grow. If economy grows, corporate profits will grow and they will get reflected on the stock prices. Today, from the list of Fortune 500 companies, which are not there in India, all the remaining ones are actively considering stepping up India operations. So instead of focusing on short-term views, let's look at great businesses that will gain in the journey of $5 trillion economy in next 4 to 5 years from the current $3.5 trillion economy. So before I hand over to Mrs. Nirali Bhansali for an update about Samco Flexi Cap and ELSS fund, I want to share 2-3 facts in which you yourself interpret what they mean. So India or China, where will investors go? So China, the first part of this clip is, so this is of July, 11th of July. China slips to brink of deflation, adding to urgency for stimulus. And the article below, this is for India. The net direct tax mop-up rises 16% so far this fiscal. And the line below, if you see, collections hit 26% of budget estimate kitty, swells on economic activity. So India, if income tax collection, and this is at an aggregate level, if economy rises, if economy is in good shape, then only income tax collection will rise. And this is where India stands today. So it requires no further application of mind that is India growing? Answer is yes, India is growing, it is strong, it is resilient. And China today, China has got a large proportion of investors' fund. Every single penny that investors have, they are thinking that why not India? Why shouldn't we invest in India? So there is a huge inflow that is coming in India and the trailer that we have seen in last 3-4 months. So tell me one thing. So if I can go to next slide. So can a bull market top out in 4 months? So assuming March, this current rally that we have seen sometimes from March or April beginning, just in 4 months, we have where we are today. And investors are thinking that all-time highs have achieved. Is it time to get out? Shall we cash out? Shall we take profits? Answer is no. See, if you see on the right side bottom below, number of stocks making 52-week highs. Today, there are only 6% stocks from the entire market. But if you see these past bull market tops as late as 2 years ago, see this percentage was 14-15%. And the 2008 bull market top for that matter, the number was still higher. So today only 6% of the stocks are sitting at 52-week high. That means this rally has a lot of room to go. We are in a secular bull market. Currently, it is possible from a short-term point of view. We are too hot, or for that matter, market has really run up because there is a large few are suggesting that there is a large corporate event on a larger index heavyweight. Short term, yes. Near term, yes. Market could be overrated, but investor has to see a longer term picture. If he does not invest, I think there will be a lot of missed opportunities. So yeah, this is where we are in terms of broad macros. India is growing. It is growing very fast compared to other emerging market economies. Money is going to come to India. And even in a short-term perspective, the market breadth that I was sharing, we are still, there is much to go before we reach those optimism, before we reach investors' euphoria. So still there is a long way to go. So yeah, over to Mrs. Nirali Bhansali on our Samco Flexi Cap and ELSS Tax Saver Fund portfolio and scheme update. Thank you. Over to Nirali.
Thank you. And basically, firstly, thank you everybody for joining us today and taking out the time. So today's agenda is very clear. First, I'll take you all through the FlexiCap Fund's performance analysis and in the past 1 year, what has worked for us and what has not really worked for us. We'll also see what are the future expectations and the growth opportunities that we see with the FlexiCap Fund going forward. And after that, we'll move on to the Samco ELSS Tax Saver Fund. So we have just finished around 6 months with the fund. And there I will actually show you all the roadmap that we have for the ELSS Tax Saver Fund's portfolio and also what we expect from that fund. Then we can move on with the Q&A. So let me directly get on with the FlexiCap Fund first. So we started FlexiCap Fund, our NFO was back in February of last year. And because we have completed over a year, you can see that June 22, which is last year, we had an AUM of around 559 crores. After that, from there onwards, till date, till around the 30th of June this year, we have garnered almost 764 crores of AUM. So that is a big jump of over 25% in terms of AUM. But after the inception of the fund, there were a lot of challenges. Russia-Ukraine war broke out. And even then, so as being a growth portfolio, definitely there was a downslide that even we witnessed in our NAV. But from June to June, if you see, we have picked up really well. It has gone up by almost 16%. So if somebody would have put their money at 8.36 NAV and exited at 10.43, which is over here, this jump, this return that they would have made as an investor would have been almost 16%. So this is what our runway of growth was. And even in the past 4 months, if you see, we have picked up beautifully. And this jump has also been very, very strong. So what I'm trying to say is we definitely saw a big downslide when the fund came out in last February. But after that, we have picked up really well. We have narrowed down the gap of underperformance that we have had with Nifty as well as the category average. And this is exactly what I'm trying to say. If you see in the last 6 months itself, our fund delivered around 10.25%. And in the same time period, Nifty delivered 6%. So that's almost a 4% alpha that our fund has generated compared to the Nifty. And if you see the FlexiCap category average, it is 8.36%. So here also, there is almost a 2% alpha that our fund has made. If we compare our fund to the benchmark as well as the category average in a 1-year time frame, again, yes, if you see this, there has been an outperformance and also with the benchmark as well as the category average. And we aim to increase this outperformance over a longer period of time and continue going forward at this run rate so that we will be able to deliver returns for our investors going forward. Having said that, before the inception of the fund, we had made a promise that we will follow a simple E3 strategy. This strategy is very clear, very transparent. The first leg is that we will always have efficient Hexashield tested companies. What do I mean by that? That we will always have quality businesses in our portfolio and aim to generate returns because these businesses will be compounding engines of the future. So our adjusted ROC today is around 30%, whereas the benchmarks is around 21%. So there is a huge gap in terms of quality that our fund delivers. Even if you see our valuation, which is the second leg of the strategy, we do not believe in buying companies at any price. We pay a very justified price for it. And on an adjusted free cash flow yield basis, we are at 2.1%, whereas the benchmark is at 1.6%. So here you can see that we are actually attractive. This is, you have to consider it not like the way you see PE, it's the opposite. So therefore, if you see there is an undervaluation that you observe over here, that means that our fund is extremely attractive at current levels compared to the benchmark. And it is definitely, there is a good scope for good margin of safety ahead going forward that investors can get with this fund. Also, the third leg of the strategy is that we have maintained an efficient churn and cost structure. So just because something has moved up in any other stock, we haven't jumped the bus for a very short period of time. So this is not a trading fund that we have here. We are trying to build a very, very robust portfolio of very quality businesses and efficient companies, which will help deliver returns over a longer period of time. So therefore, we are very disciplined about our approach, and we have stuck to our strategy of maintaining a minimal turnover. So the turnover in the past 12 rolling months have just been 0.08 times. If you see, we had promised one other thing, that our portfolio will always be different than the index. So we have maintained that our active share is above 85% consistently, if you see, month after month. And therefore, we are not delivering a portfolio which is the same as the index. We are not doing index hugging. And we are genuinely trying to provide a portfolio which is different than the index. And it is an active portfolio. So this is active management that we are doing here with this portfolio. Having said that, I'll move on with the portfolio update and the constituents that we have in the portfolio. So we have around 25 stocks in the Flexi Cap fund currently, but it is still a very well diversified portfolio. So we have 7 different themes that we are playing with, or actually underwriting with the Samco Flexi Cap fund. And these 7 themes is where our exposure lies. So cloud and AI, as you all are aware, it is the future. All businesses, be it big or small, are implementing cloud and AI in their business in some form or the other. So therefore, if you see, our exposure also is at around 21% with cloud and AI. Financialization of savings and lending, 26%. And you all are aware that as India's economy grows, finance sector is definitely going to boom. And even in the index, in fact, it is a very large chunk of our benchmark index as well. So we have around 26% there. When it comes to consumption, as inflation is abating, as the rural pickup happens, consumption is going to benefit. So there we have around 14%. Now, there has been a lot of CAPEX that has been happening. And to benefit from this CAPEX, to leverage this CAPEX, we also have exposure to proxy, infra, and auto. Software and innovative tech platform businesses, they have been the talk of the town since the past almost a decade now. But going forward as well, because of network effects, because of the future that the future tech that they have for EV, for autonomous vehicles, all these companies, almost a 12% exposure that we have to it, will be beneficial in the portfolio in the long run. Healthcare and pharma is again very, very defensive sector that we have in the portfolio currently. But it's not that we have only generic pharma. We have very, very niche businesses that we have allocated our AUM to, and we have exposure to. So together as a whole, it is a very well diversified portfolio with 25 robust businesses that we have. And we have deployed almost 98% of our AUM to these 25 stocks. 92% is in Indian equities and around 5.69% is to international equities that we have. So our cash exposure is very minimal currently. It's only around 1.85%. As I already mentioned, it is a very well diversified portfolio. We have exposure to various sectors, various industries, but even from a market cap perspective, we are genuinely offering a flexi cap portfolio. So if you see, we have 56% to large caps, but around 40% exposure to mid and small caps. So we want to maintain this ratio even going forward, because we see a lot of potential from mid and small cap businesses as well. As they grow, as they become the future of India, you can see, you can be a part of this growth story. So therefore, we have 40% exposure to mid and small caps and 56% to large caps. Having said that, as I mentioned, we have not made very rash decisions in terms of jumping in stocks. So the turnover in this portfolio has been very, very minimal. And all the decisions are either from a fundamental perspective or they were from a tactical perspective. So the entries that we have made in the past year have only been 4, and all 4 businesses have been, because our investments in all 4 businesses have been because we can see the growth story playing out in their industries. We can see that they are going to capture a higher market share because of more penetration. They develop category, new categories are being created. There is dominance over there, and there are so many other levers that will benefit these companies, and their compounding engine will continue. So because of these reasons, and because India's emerging economy is growing, you can very well bet on these businesses and have exposure to them and rely on them to deliver the returns that you require as an investor. Coming to the exits now. Yes, we have exited 3 stocks from the international portfolio that we had initially. So we had around 8 stocks in our portfolio, and we've reduced it to 5. Now, the reason for that is that initially, once we came out with our fund, SEBI and RBI, there was restriction on the entire mutual fund industry to add further investments in direct foreign equities. Because of that, we couldn't add more money on the foreign side. And therefore, we decided it was best to consolidate the portfolio over there and reduce the number of stocks. And also, FIIs now have been putting a lot of money into India. So this decision is also so that we could have a higher exposure to Indian equities and benefit from them. Muthoot Finance, yes, we exited the stock the last year, and the main reason for that was fundamental. We saw a barrage of banks, NBFCs getting into the gold finance space. And because there was so much competition that got added over here, the business model or the moat of Muthoot Finance was definitely had been affected. So before it could affect the fundamentals of the business and could not play out well, we decided it was best for us to exit the stock. So these were the reasons for our entry and exits and our rejigs. But overall, what has helped us and not helped us in the portfolio, let's see that. So if you see our 1-year attribution analysis, it's very clear that our leading contributors, Bajaj Finserv, Aditya Birla Supreme, Bajaj Finance, JB Chem, all of them have been the top 8 stocks of our portfolio. So this compounding or the returns that they have delivered have benefited us in terms of adding to our NAV. In terms of our detractors, yes, in the entire year, there have just been 3 detractors for us, Crompton Cams and Jubilant Foodworks. But what we see in them is we have not exited these stocks, and there was more variability in their price rather than the fundamentals. And because of that, they were detractors. But that doesn't mean that their growth story has stopped or their compounding isn't going to play out. So we are very well convinced with these detractors as well, and we will continue to observe them, and they still form a part of our portfolio. From a fundamental perspective, see, quality is not something that we want to compromise over here. So if you see in the past year, the quality of our businesses has remained intact. Our fund accounting ROC or adjusted ROC is much higher. It's 27 to 30%, whereas Nifty, which is our benchmark, is around 19 to 21%. Our ROIC, the latest number or the 5-year average, if you see, is still higher than the Nifty. Now, you all are aware of the fact that in the past 1 year, inflation has been continuously rising. But with that inflation, with all the commodity prices pressure, raw material pressure, etc., gross margins have still been very well maintained, and they have been around 65%, whereas Nifty's was around 43-44%. Leverage, as interest rates rise, leverage of these businesses increase, they have to pay interest ahead. But our businesses was not that affected because our businesses overall on an average debt to equity ratio is just 0.2, whereas Nifty's is at 0.57. Even if you see sales and PAT growth of the past 3 year or 5 year, it's been above what Nifty has delivered. So quality, there has been no compromise when it comes to non-financials and even financials, because pre-tax return on equity is more for our financial businesses, and they have good capital, as in capital adequacy ratio is very well maintained. So there's 21% for us, and Nifty's is at 18%. So overall, if you see, yes, portfolio is very robust in terms of quality, and that these businesses have a lot of potential going forward as well to deliver EPS growth, to deliver compounding, to deliver the returns that we as investors would like to generate from these kind of companies. Let me show you a roadmap. So this you can maybe take it as a roadmap, because this is what the analysts that we have in the industry have predicted in Refinitiv. So this is Refinitiv data from the analyst community and what they expect from our businesses going forward. So 2-year CAGR EPS, they think that on an overall basis, so this is for the individual companies, that what they feel these businesses can generate from 2 years down the 2 years down the line. But overall, if you see the weighted average, it comes to almost 20%. And as you all are aware that what happens over the long term is the EPS growth and the price, they coincide at some point in time. So therefore, if you say that the EPS growth expected from these businesses on an average basis is almost 20%, the price can definitely follow over there. So that is what the analyst community is projecting in Refinitiv, and this is what the roadmap is for this fund also from all the investors, analysts out there for the future. As I already mentioned for the valuation bit, that our business's adjusted free cash flow yield is currently at an attractive level. But even if you see on a PE basis, our current PE compared to the 3-year average is still very attractive. So be it valuation, be it quality, we are not compromising in any case. So it is a win-win situation for our investors, because valuation, quality, both will be maintained, and we also will stick to our strategy and maintain the discipline, because discipline in investing is very, very important. So this is what I wanted to convey in terms of the Flexi Cap fund. Now coming to the new fund that we have, which is Samco ELSS Tax Saver Fund. So Samco ELSS fund started in December. We had our NFO in December where we garnered around 30 crores. So since then, if you see, there has been almost a 75% jump to 53 crores of AUM. So this is the AUM growth that we have witnessed. But even in terms of our NAV has also gone up from 10.03 to 11.02 in just 6 months, and which is almost 11% rise. So the Samco ELSS tax saver fund is very different than the Samco Flexi Cap fund. And why do I say that? It's because of its unique portfolio. Now, there are so many ELSS funds out there, but what makes Samco's ELSS fund different is it doesn't have a single large cap stock. So the entire exposure, 80% of our exposure is to mid and small caps. And currently we are holding almost 20% cash, which we still have to deploy. Now, as you all are aware that markets and mid and small caps especially have also run up a lot. They are also at their all-time high levels. So there have to be opportunities where we want to invest, which are at the correct valuation. So therefore, we are holding this cash right now. But whenever we see opportune times to invest in the market, invest in the stocks that we hold, we will continue to increase our exposure to these businesses. Having said that, with this portfolio of mid and small caps, it's not that we haven't maintained diversification. In fact, we have 35 stocks in this portfolio. And again, right from technology, finance, consumption, auto, oligopoly, healthcare, chemical, we have exposure to everything. So it is a very well diversified portfolio, and risks will be very well managed because we have 35 stocks. We are, if you see the exposure to these businesses in terms of weightages, that is also very well diversified. So it's not that we have a very high concentrated exposure in any one particular business. So this will help our fund manage the risks efficiently despite being in the mid and small cap space. So overall, if you see from our AUM, we have deployed 80%. And 19% is the cash that we hold as of June end. Again, over here, going forward as well, we will follow the same E3 strategy, which is investing in quality businesses. And till now, again, with mid and small caps, we have not hampered or messed up on the quality. Our businesses, our 35 stocks are 33.9% in terms of adjusted ROCE. But benchmark is at 21%. Even in terms of valuation, as I mentioned, we see SFCF yield, which is on an adjusted basis. Here you can see, yes, there is slight overvaluation, but that doesn't mean that markets will never give us opportunities to invest. So the corrections are a good time to invest if you think that valuations are still appropriate. So that is how we will continue allocating the remaining cash that we have to these businesses going forward. And we will also maintain a very, very efficient churn and cost structure because we don't want to do a lot of turnover. This is, again, not a fund where we are going to jump stocks and we are just chasing stocks which are in momentum or not in momentum, etc. For that, we have a different fund and a different strategy. But for this one, it is more of a long-term approach that we have with the businesses that we hold and the exposures that we have. Again, with the Samco ELSS tax saver fund, our active share will continue to be at 96.68%. It is still now. And going forward as well, we will maintain at least, we will try to maintain it above 80%, which is going to be different than the benchmark, and it will not be index hugging. So with these mid and small cap businesses, why quality plays a very big part is because we don't want our businesses to die down. So there can be so many challenges. Macros can go wrong. There could be other issues with the Indian economy, which, might just, anything can happen anytime. Like COVID, nobody had expected. So what happens during those times is businesses have to survive, businesses have to continue to grow, and for that quality matters. And therefore over here also, even though they are mid and small cap businesses, we have quality, we are looking for quality businesses. So our adjusted ROC again is much higher than the benchmark at 27-33%. Benchmarks is at 19-21%. Our ROIC is again at 24-20%. Nifty's is at 15-17%. Gross margins again much higher than the Nifty. Debt to equity is lower than Nifty, and sales and PAT growth have also been good and strong. So together, with be it non-financials or financials, we are maintaining the robustness that we have with the businesses that we hold, because what happens is these small and mid-cap businesses, as they grow, as they become the future large caps, mega caps of India, we can benefit from this growth story or this entire journey and leverage them to make returns for our investors. So therefore, we have this unique portfolio that we want to maintain in the Samco ELSS Tax Saver Fund. So this is what our update was in terms of both the funds. And if you see both the funds, there are some common factors and some different factors. So the common factors are that we will continuously stick to our strategy. We will have a disciplined approach. We also follow in this saying that when it comes to investing, inaction is often the best course of action. But does that mean that we are complacent? Not at all. We are very, very active about it in terms of looking at all the stocks in the portfolio, continuously studying the businesses, being updated about how things are moving and how macros or other factors can affect our businesses and their models. So it doesn't mean that we are complacent with the fund. It just means that the compounding will the compounding will play, or the compounding benefit will happen when you hold stocks or you invest in a portfolio for a longer period of time. And that is how we also wish to maintain both these funds going forward. In terms of the differences, Samco Flexi Cap Fund is a flexi cap portfolio, as rightly the name says. It's into large caps, mid caps, and small caps, whereas the ELSS portfolio has only mid and small caps. So that is a differentiating factor between the two funds. So yes, this is what we had to convey from our side in terms of both the funds, but we can get on with the Q&A, Chirag.
Thank you so much, Nirali, for the presentation. We've got a couple of questions. Mr. Mehta, Dhawal, and Nirali, I'll bounce it off to you as and when they come, and you can take them. So, Mr. AR wants to know a general view of ours, of Mr. Umeshkumar and team on the chemical sector as a whole. So, if you could comment on that, it would be great.
Yeah, I'll take it up. So as I showed you in the portfolio, in the ELSS Tax Saver Fund, we have exposure to chemical stocks. Having said that, industry as a whole, yes, there could be some normalization because the chemical sector saw a big jump post-COVID because of the China +1 strategy and other benefits that played out for us, because we are the lower cost market and we were the substitutes to the world. But what is happening now is when something excess happens, there is always a period of downtime. And you can maybe look at chemicals as a period of downtime, but from a shorter time frame. So it's not that all these benefits that people are talking about won't play out in the chemical sector over the long term. Yes, India stands to benefit as exports grow, as the demand increases from across the world for these chemicals, for these specialty chemicals. There is going to be growth and there is going to be demand from our businesses, because our businesses have the niche to supply to the world. I hope I've answered your question.
Yeah, thank you so much, Nirali. Dhawal, there's a question for you, and Mr. Suresh wants to know that since now the US markets have started doing good, is there any way that the Flexi Cap scheme will plan to invest more into foreign equity or increase the weightage?
Okay, so thank you, Suresh ji, for your question. So back in January 2022, RBI had restricted, mutual fund houses to stop taking fresh subscription in schemes which are invested in overseas stocks. So, this move was stopped subscription mainly on account of the mutual fund industry as a whole. They were crossing the mandate of $7 billion limit of overseas investment. And even recently, RBI said that, there is no proposal to increase the overseas investment limit for domestic mutual fund houses at the moment. So, even if we would like to also add a few of the international names, mutual fund houses' hands are tied. I hope I answered the question.
Mr. Dhawal, if I have to top that question up, that just in case, let's say if the limit opens, assumption, would you and your team be looking at investing more into foreign equities?
So as a scheme mandate, we can go up to 35% of our AUM. So right now we have only, sub of 6% exposure to international stocks. And of course, as and when it opens, we'll be, we'll see the valuations of how the, what are the prospects going ahead, and we'll take a call accordingly.
Got it. I have one more question from the gentleman. I don't have his name on the call, but he wants to know that why there are no banking stocks in either of the portfolio. Any specific reason or any input? If Nirali or Umesh, if you could want to add up.
See, the regulations today, I have a little bit of different view on the NBFC and on the bank side. So over here on this side where the banks are being regulated, it is the RBI who says that we are going to decide, or our permission CEO will be decided. We will have a final say. There is this constant the process of reducing shareholding, but that is not there in NBFC. So NBFC shareholding, the ownership structure is not changed. So long as they take care of all the rules, regulation, they will not get into the change in CEO or the ownership. So from a regulator perspective, I think NBFC has far more visibility, far more comfort level, given where banks are. So that is one. Second, in terms of, bank lending is the only business that works 24/7. So which vehicle that if we want to invest our investors' money is there. And NBFCs are growing at a faster rate than compared to the banks. So therefore, growth factors it ticks the checkbox. Second is in terms of margin, in terms of all other parameters. NBFCs has a higher checklist. The ticks are more than compared to banks. But I think the major thing is the regulatory overhang over VC. NBFC has the least risk of that, and therefore we have aggressively invested in NBFC.
Thank you, Mr. Mehta. One question by Mr. Gurmeet Ahuja. He wants to specifically understand the Bajaj Finance valuation in the portfolio, and his worry is that any earnings disappointment could impact the portfolio. So any one of Nirali or Mr. Mehta, if you could explain the valuation part also in general. I know Nirali, you have covered this in your presentation, but still if you could just touch upon it quickly.
Yeah, I add, and then Nirali can add over it. See, Bajaj Finance valuation, people look if it is trading at around 8-9 times price to book, it is available at a high valuation. Historically, Bajaj Finance has traded at around 10, 12, 13 times price to book. And given that alone valuation itself, that look, 8 is high or 9 is high or 13 is high. So long as the growth is intact, I think that is where we need to understand that if company is growing by 30+%, and if that is the run rate that it is going to maintain, then I think that is a fairly reasonable valuation. Given that this India as a market, the financing market is going to grow. It is going to get bigger and bigger. The pie is getting bigger, although the newer players will come in. So this is how we will have to think that some 2 years ago, 3 years ago, when Kia Motors, MG Motors came, people had the same thought on Maruti. Oh my God, Maruti is a dominant player. Margins will get impacted. Growth will not happen. But look what happened to all those 2 years down, 3 years down the line. Maruti is where Maruti is because the market has expanded. The growth was there. And therefore, stock prices have delivered. So Bajaj Finance, I think, yeah, we are also watchful, but so long as the growth engine is intact, we don't think things will get out of gear. Nirali, you can add.
Umesh Mehta ji has conveyed it beautifully and summed it up. But just to reiterate, yes, there is always a price that you pay for quality. And if you're getting a business which is growing at 32%, even at this scale and size, and still getting, into every village, getting into every town, trying to capture more and more of the pie and helping our economy grow, then why not have exposure to it? It is still growing, right? So irrespective of a valuation, so that's why we always say you buy it at a justified valuation. Don't just compare. There is always something called as valuation re-rating. And if something deserves a re-rating, then you should give that re-rating to it. So that's why also we continue to hold Bajaj Finance in our portfolio.
Thank you, Mr. Mehta. Thank
Chirag,
you.
just
One
to
question
add,
by Mr. Huzefa.
Chirag, just to add.
Yeah,
Hi.
yes.
Yeah, just to add, I think it was an excellent question by Gurmeet ji. But just to give a perspective about how we think about Bajaj Finance. So even the AUM of Bajaj Finance is close to around 2.5 lakh crore, and it's only under 2% of the whole banking sector of India. So the growth opportunity, the pie is, as Nirali said, the pie is getting bigger and bigger and bigger and bigger. So there is a huge, growth runway for Bajaj Finance and even newer NBFCs to come to, and have business in India. Thank you.
So Nirali, there's one more question. If you could take it up, that Mr. Huzefa wants to know that why on ELSS scheme we still hold 20% in cash.
Sure. Thank you, Mr. Huzefa, for the question. And I'm sure others will also have a similar thought process, or they would be wanting to ask this question. So, Mr. Huzefa, as you know, mid and small caps have definitely have seen a huge runway in the past couple of months, especially from when our fund began. So we have been very cautious that we don't overpay for a particular business. And what we are doing here is, with every correction that we have in the stocks that we hold in the portfolio, or any other opportunity that we see which is at a fair valuation or it is undervalued, that's where we invest in these businesses. So from this perspective, we felt it best because it is definitely that the returns have to be delivered, but you cannot compromise on the risks of the portfolio, and risk management is also a very big part. So we don't want you all to see a lot of drastic volatility, and we also want to deliver the returns to our investors, and therefore we are being very cautious with the investment approach. And having said that, yes, the remaining 20% will be very soon invested in these businesses or other businesses as we see it fit in terms of the valuation and how the economy is behaving, and especially how the businesses that we hold are portraying in what price is justified at these levels, or what price should we actually pay or we are comfortable paying, because we do not want to disadvantage our investor in any way. So this is what our thought process is, and that's why we hold the cash that we hold.
Thank you, Nirali. There's Mr. Akshay wants to know like a quick overview on the IT sector, since we have it in our portfolio as well. If you could just take up like a 30-second, 40-second summary on the sector.
Anyone else wants to take it, or I'll take it up?
No, I'll take it. That's fine.
Okay.
So if we look at IT sector, we have seen mid and small cap, few of the companies run up quite beautifully. Like they have grown 50-60% returns in the last few months. But there we have seen a positive correlation with Nifty IT and Nasdaq 100. So if we go to the fundamentals of Nifty IT index, the ROE is close to about 25%, whereas Nasdaq 100, the ROE is 19%. And this indicates that in the long run, the returns which the equity holder will get from investing in Nifty IT is quite better. Even when I talk about return on asset of Nifty IT index, it is way better than Nasdaq 100, and which demonstrates, the higher profitability from the asset utilization of Indian companies. And therefore, with this higher profitability, better asset utilization, and more favorable valuation, since if we see valuations from last 1 year, banking sector, like people more are overweight on banking sector, whereas the IT sector hasn't done much as, compared to previous years. So, we think that Indian IT sector as a whole presents quite a compelling opportunity, and this whole wave of AI, the whole transformational projects which the Nasdaq 100 companies want from our Indian company is, quite beneficial for our Indian company. And, it is a trend across various sectors and industries that, once an underperformance, the outperformance is followed. So, this is what our view on IT sector is.
Thank you, Dhawal. There's one question that has appeared twice. So I would like to, any one of you, if you could take up that, should Bajaj Finance be worried about the newer competition entering the NBFC market? I know, Dhawal, you slightly touched upon that there's a huge runway and there's so much pie for everyone. But if you could quickly just, again mention that, does Bajaj Finance have to worry because of Geos of the world or any other players that might, enter the similar business?
Okay, so again, giving few data point or data keeping, like I'll tell that Bajaj Finance, it drives over half of the consumer loan in volumes of India. 30% of electronics is being taken through Bajaj Finance, and 27 odd iPhones which are sold in India are through Bajaj Finance. So Bajaj is the behemoth which it has created itself. And with 2.5 lakh crore of AUM, Bajaj, the management has told that it will grow 20, like the growth momentum would be close to around 25 to 27 odd percent, maintaining the growth profile, and of course, and NPAs, and ROE would be delivered close to around 19 to 21 21 odd percent. Now, of course, RIL has taken a very big step, by creating a separate entity and demerging the financial arm. But, and of course, they have data of 40 to 50 crore geo connection. But, now the next question is, would that data or, would that data recharge pack would help them in any other way, which Bajaj Finance doesn't have? Bajaj Finance is in business since close to around 2009, 2010. So, why we like Bajaj Finance is because the big AUM and growing at a very, very fast rate. So we have Bajaj Twins in our portfolio because of their superior capital allocation strategy, and of course, delivering on the new strategy. And it will be in our portfolio until it keeps proving itself.
Thank you.
Just to add, I want to add one more thing. That whenever there is a new competition or a new competitor enters an industry, it doesn't mean that the original player has to die down, because it's just a 2% of the entire pie. So you can imagine there is 98% to be covered. What will happen is they both can coexist. Maybe at the start, Jio does something at a higher growth rate, but that's fine. It will take time for it to reach a Bajaj, but by then Bajaj Finance, the big would have become bigger. So there are so many industries where there are so many other players. It's not that the telecom industry, initially when it also witnessed competition, everybody died down. There was consolidation, it took time. Then there were players, there was a lot of mergers. So all of this takes time, but that does not mean that at the start, just because a player says that we want to enter the industry, that the original player suddenly doesn't see growth coming into its business, right? So that's how also we look at it. And that's why also we have Bajaj Finance.
Thank you. Thank you, Nirali. One more question by Mr. Vikas Kumar, and I've seen these names again and again popping up in the chat. So, if you could tell us that Jubilant Foodworks and Asian Paints have not probably participated in the rally or contributed to the growth. So, will we look at replacing them, or if you could just throw some light on both of these stocks?
Sure. So I'll start with Jubilant Foodworks firstly. With Jubilant Foodworks, yes, there was, it got affected by inflation to an extent because of the milk prices, the wheat prices, etc. But going forward, we feel that there is a lot of potential, firstly, because of the store openings they have, the newer categories like Popeye, etc., that they are now getting into. And they have also, the last year, they've come up with a loyalty rewards program. Now, in Domino's Inc., which is the US company, when they had come out with this same loyalty program, what had happened was in the next 3 years, their SSG, the same store sales growth, had grown by 2x. And their EPS growth had also jumped by almost 1.8 times. And this is basically also what we feel that Jubilant will be able to leverage, as in it will be able to showcase this kind of a behavior even going forward. And the other QSR businesses which are there currently in the industry, yes, some of them are doing well, but we see in comparison to them, we see that the ROC compounding will definitely play out better with with Jubilant Foodworks, and also the SSG and the new store openings will be of benefit to Jubilant Foodworks. Dhawal, you'd like to add something on Jubilant?
No, I think it pretty much sums it up.
Okay, and when it comes to Asian Paints, so Asian Paints, I think everybody knows why Asian Paints is Asian Paints today. And that is also one example, as in despite all the competition that we see in the industry, the capacity additions that we see, even then the moat hasn't been disturbed. So Asian Paints moat is the distributor community it has, the machines that it has, the machines basically that it has with the distributors, the turnaround time, the data that it has, the data is key. So because it has been gathering data now, which shop in which city requires which color paint and which paint is sold at what time, now that is called data. And therefore you supply that paint bucket over there at that point in time so that the sales happen faster and then there is less inventory. Because of these reasons, Asian Paints is what Asian Paints is today. And despite all of this, it has been able to deliver. Obviously, there has been suboptimal growth, but it's not that 1 year suboptimal growth means that it will never grow. What we expect is even going forward, it will be able to grow. And having said that, the price is in terms of Asian Paints is also a factor of the crude oil prices, which are global prices. So the global crude prices are basically on the are very much dependent on demand and supply that we see across the globe. And it's not only dependent on Asian Paints and what it's delivering from a fundamental perspective. So we have to look at Asian Paints from both these buckets, as in terms of the fundamentals that it has, also the impact of crude oil prices, because that is a key raw material that is used to make paints, and titanium dioxide, which is basically the raw material. So the gross margins, the EBITDA margins of this business will very much depend on that. And that's something we are closely observing. So whenever we feel that this is not the price that we want to pay for it, or we feel that there is definitely a rupture in the paint business in terms of what Asian Paints can deliver going forward, we will decide to exit it. But at this point in time, we don't see any challenge with Asian Paints, and therefore we continue to hold it.
Thank you, Nirali. There is one question by Mr. Pandya that Mr. Mehta, if you could take this up, that do we invest in IPOs in our fund? The first part of his question is already covered by Dhawal previously. So, Mr. Mehta, if you could just cover that, do we invest in IPOs as a strategy?
No, the simple answer is no. We don't invest in IPOs because we need a little bit of history, background of company, public data, which passes through our Excel framework. And there are so many opportunities out there in the secondary market where we have proven time-tested companies for our investors to invest rather than getting into newer and newer companies. So as in general, we don't invest in IPO.
Okay. I think we've mostly covered all the questions. There is one question which is very subjective, but which industry do we expect to contribute to the return most in the next 5 years in the portfolio? Mr. Mehta, if you or Nirali, if you would want to highlight, this is very subjective, but still.
So I think IT as an industry, we think, say in last, if we analyze returns over last 20 or in fact 30 years of data in Indian market and 70 years of data of US market, the major part of return comes from, and this is a surprise to all, it's re-rating. So today IT as a sector, as an industry is high teen, low teen, and some of the companies are trading at 20, 25. This is what the multiples that currently markets are giving. But given the longevity, sustainability, visibility, consistency, these are the four things that makes ripe for re-rating. And this is what historical factors are. So next 5-10 years down the line, we think IT as a sector will get massive re-rating. And the biggest returns the history has given is comes from re-rating rather than earnings growth. So there is a steady state double-digit growth from IT sector, but the re-rating part is now going to happen. And we have aggressive allocation of 25%, which no other in category, I'm told, that have that kind of allocation. And now the time has come for IT as a sector. And this is what the market is also showing. So yeah, we have aggressive bets in IT, but logically and data from data speaking point of view, I think this sector is ripe for re-rating and therefore massive returns by holding those stocks.
Also, if you see, IT is a very broad name that you give a big sector, as in there are so many small buckets. Now, IT can be used in every industry. IT has so many forms. There is AI, there is ML, there is cloud, there is other data analytics. So there are so many different sections in IT, and there are so many innovations happening every day. So when Umesh ji says that yes, IT, but that does not mean that we are just looking at the old school IT kind of a technology implementation from these businesses. What we are also aiming at is everything future, is everything innovative, everything that is going to be used in these industries going forward. And that is why we are saying that the next 5 years will be for IT and technology as a whole, because there is so much to it, so much layering, so much depth, that it blows our mind. It is new for any human being out there. So everyone's trying to figure it out. And as we speak also, there are new innovations happening. So IT, be it in robotics, be it in EV, be it in autonomous vehicle, be it in energy space, there is IT everywhere. And that's why IT kind of sticks or joins everything together. And that's why we feel that IT going forward is going to be really transformational for our industry, and for basically for India as a whole.
Thank you, Nirali. One last question, Mr. Mehta, if you could quickly touch upon, Mr. Huzefa wants to know that what are the cons in the current market in the short term? I mean, if you could just, give us your insight.
So in the short term, so number of stocks so the breadth of the market is stalling, or for the matter, the breadth of the market is now not excited. So because there is a corporate event in one of the index heavyweight, we are seeing the index is moving higher, and therefore we are seeing little bit of euphoria out there emerging right now. So in the near term, market could be overheated. But as I told you, that is only a near term. From a medium to longer term perspective, I think this is a secular bull market, and one should not think of getting out right now and then again buying back when the markets fall. That strategy is absolutely not to be done, because we are in a secular bull market, and therefore you have to keep on holding and ride this bull market. The question is, can I invest right now my money? Answer is to the lump sum. Answer is no. You will have to stagger your investment, because this is how you will get the averaging benefit. And we have one good product, Timer STP, wherein in a year's time you will be able to deploy, depending on the market valuation, the entire money will get deployed. So lump sum, I think the answer is no. Currently market valuations are very lofty, but so that is where it is. But from a longer term perspective, you have to remain invested in equities aggressively, because this is a start. This is a loud and clear signal that look, bull market is emerging, and we have to get our entire body into the market.
Thank you so much. So I think we have covered all the majority of the questions. There are other comments about specific sectors, and that we should also look at sectors like EV or auto. So I've not covered them because these are inputs for you guys. So I have a recording of this chat, and I will share it with Mr. Mehta and team after this call. But on behalf of the whole Samco Mutual Fund team, I would like to thank everyone who's taken out time, attended the unit holders meeting. This is an effort from our side to keep you updated about what we are doing with the scheme, how is the scheme performing, the past portfolio, etc. I hope this insight has helped you a lot. Once again, thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.